All right, let's get in Ed Yardeni, President at Yardeni Research, on the show now. Ed, thank you very much for joining in. We were just unpacking what Powell had to say at the Jackson Hole Symposium, and it pretty much seems a certainty a 25 basis points rate cut is coming in September. But the question is, can we get 50 basis points rate cut by the end of the year? Give us your overall thoughts and the global equity market positioning.
Well, I think what really changed in Powell's message on Friday was what he didn't say. All year, he's been saying that the Fed is in no rush to lower interest rates. So that's a dovish statement, but it's not terribly dovish because it really is a pause statement saying that we're going to keep it here for a while until we're sure we're ready to lower rates. He didn't say there are no rush anymore. He said that conditions are such that a change in policy may be called for. And that implied, obviously, that there'd be a September rate cut. I'm still not convinced that it's inevitable. We have a couple of inflation numbers up ahead here. We've got the consumption deflator at the end of the month, and that could be a little bit on the hot side. And then August CPI comes out before the FOMC meeting in September. And oh, by the way, in the first week of September, we're going to get a payroll number, employment number, for August, and I think that could be about 100,000, which in the old days, a few months ago, didn't seem like a very big increase. But now I think the markets would view 100,000 as a sign that maybe some of the weakness in the spring and in May and June was just temporary, related to uncertainty related to the tariffs. That's where I'm at. So I'm not convinced we're going to get 25 basis points at the September 17th meeting, and therefore I'm not convinced that we're going to get 50 basis points between now and year end.
Wow, interesting points there, Ed. Good morning. Just a quick word. I mean, here in India, you know, that and what's happening in the US would have been top of mind in terms of the dominant driver for markets. But we've got our own kind of issues with regards to these tariffs, and the deadline is this week, middle of the week. How should one think about these? I mean, I was saying earlier that, you know, 25 plus 25, 50 permanent tariffs at that. I mean, obviously, it can't be. It'll be negotiated lower. Is that how you should kind of sort of look at this? There are lots of stocks, by the way, which were primed to benefit because, I mean, even 3 weeks back, actually a month back, it was being expected that, you know, India perhaps would benefit. It's gone exactly the opposite way. What's your sense, Ed?
Well, my sense is it's a very hard thing to predict here because you just don't know what President Trump is going to do next. But he is in negotiations with India, and India seems to be facing a heads you win, heads you lose, tails you lose. If India caves in on his demand that India not buy Russian oil, that obviously is cheaper than buying it in global markets, then that'll hurt India from an economic standpoint. And then if India stays the course here and continues to buy Russian oil, then India faces a 50% tariff. And I don't really know how it adds up, because right now it's a 25% tariff, but now he's saying, is the 50% going to be on top of that, or will that replace 25%? So that's the way the president negotiates. There's a lot of ambiguity, and he kind of walks into the room and said, I'm ready to negotiate. Now tell me what you're going to do for me. And so I think Modi is not exactly a fan of that kind of negotiations, where he's got to come up with what Trump expects him to do, instead of just kind of negotiating a deal that's fair to both sides. So I would be careful here. I think there's a potential for things to not work out, at least in the short run, and that could continue to weigh on India's stock market.
Hi, Ed. Good to see you. And as always, a couple of factors then. You know, earlier you were in the camp that thought that I think Fed was all done and we won't hear anything from the Fed. You're still doubting whether we see a cut in the near term. So, but by the end of this calendar year, do you think we at least squeeze in one rate cut coming from the Fed? Point number one. And point number two is, I think on the S&P 500, you were in that vicinity of 6,000, 6,500. We've got a few more months to go and we're already at 6,500. Where do you see the US market headed?
Yeah, I'm using 6,600 by the end of the year
Okay.
and 7,700 for the S&P 500 by the end of next year. And to get there, I'm using that by the end of this year, the market, because the analysts will be expecting that earnings will be $300 a share next year. And then at the end of next year, I think they'll be discounting $350 a share. And to get to my targets, I need to keep the PE at this level, which is 22, which is admittedly very high. But I am betting that the bull market continues and that it's earnings led instead of valuation led. I think if the Fed were to just go ahead and lower rates in the September 17th meeting and the market started to expect another rate cut, we'd be in a melt-up situation. We'd get to my 6,600 a lot sooner, and we'd probably be looking at something like 7,000 or more by the end of the year. The Fed doesn't seem to be taking into account here the potential for financial instability, for speculative bubbles. I mean, the stock market certainly doesn't need a Fed put, and I'm not convinced that the economy needs a Fed put. So it would just, I think, create some real potential for a volatile melt-up situation. And we saw an example of that on Friday. It was basically a melt-up. It was volatile. It was wild. It was very broad-based. And it could be more. That could be more of it if the Fed continues to persists in lowering rates when it's really not necessary.
Yeah, absolutely. Great conversation, Ed, and good perspective. Just what we needed Monday morning, just to think
Thank
through
you.
some of the stuff which is lined up.